October 24th, 1929, Black Thursday. In a single day, the American dream turned into a nightmare as stock prices collapsed, wiping out fortunes that had taken decades to build. But what if I told you that some researchers claim this wasn't an accident? What if allegations suggest the greatest financial disaster in American history was actually orchestrated by a small group of powerful men who knew exactly what was coming? Welcome to Money Secrets Uncovered, where we uncover the secrets they don't want you to know. Today, we're investigating one of the most controversial theories in financial history. Was the 1929 Wall Street crash a natural economic correction? Or do some claims suggest it was a carefully planned operation designed to consolidate power in the hands of the few? The evidence and allegations we're about to explore are certainly thought-provoking. To understand what really happened in 1929, we need to go back to the Roaring '20s. America was experiencing unprecedented prosperity. Stock prices were soaring, everyone was investing, and it seemed like the party would never end. But behind the scenes, something sinister was brewing. The Federal Reserve, established just 16 years earlier in 1913, was still a relatively new institution. And here's where our story begins to get interesting. The same banking families who had fought for decades to control America's money supply, the Morgans, the Rockefellers, the Warburgs, now had their hands on the levers of monetary policy. But let's start with what the history books tell us happened. According to the official narrative, the crash was caused by speculation, margin buying, and an overheated economy that simply couldn't sustain itself. Prices had risen too high, too fast, and gravity inevitably took over. But was it really that simple? In the years leading up to 1929, something unprecedented was happening. The Federal Reserve was flooding the market with cheap money. Interest rates were kept artificially low, making it incredibly easy for people to borrow money to buy stocks. This wasn't an accident, it was policy. Between 1924 and 1929, the money supply increased by over 60%. Credit was flowing like water, and everyone from shoe shiners to wealthy industrialists was getting into the stock market game. Margin buying, where you could buy stocks with as little as 10% down, became the norm rather than the exception. Now here's where it gets interesting. While regular Americans were being encouraged to buy, some of the wealthiest and most connected individuals were quietly doing something very different. Take Joseph Kennedy, for example. Yes, the father of future President John F. Kennedy. In early 1929, Kennedy began quietly selling his stock positions and converting his wealth to cash and gold. When asked why, he reportedly said he knew the party was over when his shoeshine boys started giving him stock tips. But Kennedy wasn't alone. A small group of insiders, many connected to the major banking houses, began liquidating their positions months before the crash. They seemed to know something that the general public didn't. This brings us to one of the most damning pieces of evidence: the Federal Reserve's actions in the months leading up to the crash. In February 1929, the Federal Reserve began what they called a direct pressure campaign. They started restricting credit to member banks for speculation purposes. On the surface, this seemed like a reasonable policy to cool down an overheated market, but the timing and execution tell a different story. Instead of gradually raising interest rates, the traditional method of cooling speculation, the Fed chose a more targeted approach. They restricted credit to smaller banks and individual investors while continuing to provide liquidity to the major banks. This created a two-tiered system where connected insiders maintained access to easy credit, while regular Americans found it increasingly difficult to maintain their positions. Then, in August 1929, the Federal Reserve raised the discount rate from 5% to 6%. This was the final nail in the coffin. With credit becoming more expensive and harder to obtain, the massive pyramid of margin debt that had been built up over the previous 5 years became unsustainable. But here's the kicker. The major banks, who sat on the Federal Reserve's board, knew exactly when these policy changes were coming. They had months to position themselves accordingly. October 24th, 1929, Black Thursday. The market opened with a flood of sell orders. Within hours, stock prices were in free fall. Panic spread through the trading floor like wildfire. But even as chaos reigned, something curious was happening. While small investors were desperately trying to sell their shares at any price, a select group of wealthy buyers were quietly accumulating stocks at fire sale prices. The most prominent example was a group led by Richard Whitney, acting on behalf of a consortium of major banks. As the Dow Jones plunged, Whitney walked onto the trading floor and began placing large buy orders for blue-chip stocks at above-market prices. This temporary intervention helped stabilize the market for a few days, giving the impression that the worst was over. But this wasn't a rescue operation. It was a strategic pause. The smart money knew that the real collapse was still coming. They used this brief respite to complete their own liquidation while encouraging others to buy the dip. Sure enough, the following Tuesday, October 29th, Black Tuesday, saw an even more devastating collapse. Over 16 million shares were traded in a single day, a record that wouldn't be broken for nearly 40 years. By the end of the day, the market had lost another 12% of its value. When the dust settled, the wealth transfer was staggering. Millions of ordinary Americans saw their life savings wiped out. Farmers, small business owners, and middle-class families who had invested their hopes and dreams in the stock market were ruined. But not everyone lost. In fact, some of the wealthiest families in America actually increased their fortunes during this period. The Rockefeller family, for instance, had converted much of their stock holdings to cash and gold in the months before the crash. John D. Rockefeller Jr. was even quoted as saying he and his son had been buying stocks during the panic because, believing that fundamental conditions of the country are sound, they felt it was a good time to purchase. Similarly, the Morgan banking empire, while publicly participating in the rescue efforts, had privately positioned themselves to benefit from the chaos. J.P. Morgan and Company used the crisis to acquire struggling competitors and consolidate their control over American finance. The Rothschild family, with their extensive intelligence network, had also prepared for the crash. Nathan Rothschild's famous quote, "The time to buy is when there's blood in the streets," seemed to guide their strategy perfectly. These weren't lucky guesses. These were calculated moves by individuals who had access to information and resources that regular Americans simply didn't have. But the wealth transfer was just the beginning. The real conspiracy, according to some researchers, was about consolidating political and economic power. The crash and subsequent Great Depression created a crisis that demanded a solution. And who was better positioned to provide that solution than the same banking interests who had allegedly orchestrated the problem in the first place? The Roosevelt administration's response to the Depression involved a massive expansion of federal power and the creation of numerous new agencies and programs. Many of these initiatives required funding, which meant issuing government bonds. And who were the primary purchasers of these bonds? The same major banks that had survived and thrived during the crash. Furthermore, the Banking Act of 1933, commonly known as the Glass-Steagall Act, while ostensibly designed to prevent future crashes, actually served to eliminate smaller competitors and consolidate power in the hands of the major banks. The Federal Deposit Insurance Corporation, FDIC, created in 1933, provided government backing for bank deposits. While this helped restore confidence in the banking system, it also meant that taxpayers were now on the hook for bank failures, creating a moral hazard that would resurface decades later. Now let's examine the claims and allegations around this conspiracy theory critically. What evidence do researchers point to when suggesting the 1929 crash was deliberately engineered? The circumstantial evidence that conspiracy theorists cite is certainly compelling. They point to the timing of Federal Reserve policy changes, alleged insider trading by connected individuals, and the way certain families positioned themselves before the crash as suggesting foreknowledge of what was coming. Researchers also reference documentary evidence of coordination between major banks. The minutes of Federal Reserve meetings from 1928 and 1929 show that bank representatives were actively discussing how to cool down the speculation without causing a panic. Critics argue their actions seem to have had the opposite effect. There's also the testimony of Curtis Dahl, Franklin Roosevelt's son-in-law, who claimed in his 1970 book, FDR, My Exploited Father-in-Law, that the crash was the calculated hearing of the public by the world money powers, triggered by the planned sudden shortage of supply of call money in the New York money market. However, we must also consider mainstream economic explanations. Economic bubbles and crashes have occurred throughout history, long before central banks existed. The Dutch tulip bubble of 1637, the South Sea bubble of 1720, and numerous other financial mania suggest that human psychology and market dynamics can create these boom-bust cycles naturally. Many economists argue that the 1929 crash fits classic bubble patterns: excessive speculation, over-leveraging, and inevitable correction when fundamentals catch up to inflated valuations. What makes this theory particularly relevant today is how similar patterns have emerged in recent decades. The 2008 financial crisis, for instance, showed many of the same characteristics: excessive leverage, regulatory capture, and a small group of insiders who seemed to know what was coming. Goldman Sachs, for example, was simultaneously selling mortgage-backed securities to clients while privately betting against the very same instruments. When the housing market collapsed, Goldman made billions while their clients lost everything. The COVID-19 pandemic created another wealth transfer opportunity. While small businesses shuttered and ordinary ordinary families struggled, tech billionaires and major corporations saw their wealth increase dramatically. The Federal Reserve's response, printing trillions of dollars and keeping interest rates near zero, inflated asset prices and benefited those who owned stocks and real estate while hurting savers and wage earners. These patterns suggest that whether through deliberate manipulation or simply by taking advantage of natural market cycles, wealth consistently flows from the many to the few during times of crisis. The 1929 crash and subsequent depression fundamentally changed America. It led to a massive expansion of government power, the creation of the modern welfare state, and established the Federal Reserve as the ultimate arbiter of American monetary policy. Perhaps most importantly, it demonstrated how quickly wealth could be transferred from ordinary citizens to a small elite during times of crisis. This lesson wasn't lost on future generations of financiers and policymakers. The families and institutions that emerged stronger from the 1929 crash went on to shape American finance for the rest of the 20th century. Their descendants and successors continue to wield enormous influence over economic policy today. So, was the 1929 Wall Street crash engineered? While we may never have definitive proof, and mainstream economists generally reject conspiracy theories, some researchers argue that at minimum, a small group of connected insiders had advanced knowledge of what was coming and positioned themselves accordingly. Whether through alleged deliberate manipulation or simply superior information and resources, the documented result was the same: a massive wealth transfer from ordinary citizens to financial elites. The patterns that conspiracy theorists claim to see in 1929, artificial credit expansion, insider positioning, coordinated policy responses, and wealth consolidation, are worth examining critically as they appear to repeat in various forms throughout financial history. Understanding these patterns is crucial for anyone who wants to protect their wealth and see through the official narratives that obscure what's really happening in our financial system. What do you think? Was the 1929 crash a natural economic correction or something more sinister? Let me know in the comments below, and don't forget to subscribe for more Money Secrets Uncovered that reveal the secrets they don't want you to know. The truth is out there. You just have to know where to look. If you found this investigation fascinating, check out our next video where we explore how the same banking families allegedly manipulated World War II financing, or dive into our playlist on banking conspiracies throughout history. Don't forget to hit that notification bell. The financial elite don't want this information getting out.